So basically, the Tax Cuts and Jobs Act was the one that allows the bonus depreciation and accelerated the amount that you could take year one, right?
Correct. Yeah. So bonus was around before that, but it made it 100% bonus versus 50. And the other key provision was that it no longer had to be new construction. So it used to have to be if you built a duplex, you did a cost seg study, you could take bonus. But now you don't have to build a duplex. You can just go buy a duplex that was built in the 70s, for example. And we come into a cost seg, and all of a sudden your 5, 7, and 15-year assets that we identify are eligible to be written off in the first year.
Okay.
So that's typically around 30% is the kind of the number that we use.
Well, that's good because I've been telling people 30 to 35%. So
yeah, no, that's pretty accurate. So yep. So we usually will find 30, 35. So if we can find 30% on $1 million asset, that's 300,000 that you're going to be able to write off in the first year, basically. So
sure. No, I think that's awesome. And then CARES allows you to take that loss back 5 years, which that's huge because you could end up with a really big refund.
Yeah, you could. The main thing for real estate investors, in order for it to create a net operating loss, they do have to file their taxes as a real estate professional.
Okay.
So like for myself, I'm not a real estate professional, so I have some passive loss limitations where it doesn't actually create an NOL for me. It creates they call it a passive loss carry forward. So I have to carry mine forward because I'm not a real estate professional on my taxes. But for anybody who's a real estate professional or an active investor, and that's what they do for a living, it does create the NOL, which is great.
So let me just talk about that really quickly for a second. So real estate professional. So are you married?
I am.
So could you make your wife a real estate professional? Because isn't it like 15 or 20 hours a week is what they have to do?
Yeah, it's 16 hours. It's 750 hours a year, or I think you do the math, it's like 16 and a half hours a week. That's the easy test. The hard test that most people stumble on is you have to spend more than 50% of your working time doing real estate. So I work 40 hours a week here, so I'd have to do 41 hours a week on top of this doing real estate. Now, my wife, she's actually in the school system, so she may be able to qualify because she has the summers off, and she only works 35 hours when she is working during the school year. So she may be able to qualify, but a lot of investors will have their spouse do just that. A lot of doctors who own their building, they'll have their wife do real estate on the side so that they can then offset their doctor income or their dental income, what have you. So
but if you're spending 16 hours a week driving, you're looking at real estate, right?
Right, right, exactly. Or 16 hours a week on the computer, you're looking for new investment opportunities. And so, the 16 hours is the easy part. It's just if you're working full time, the IRS is going to challenge you and say there's no way you're doing 40 hours of your regular job plus 41 hours doing real estate. So
right, yeah.
If you have somebody at home who's working part time or not working, it's fairly easy to get them to qualify.
Yeah, so that's kind of what I was thinking, that you could get somebody else to do that. So I'm obviously a real estate professional, but
you don't have that problem.
I don't have that problem, but that's something I've looked at. All right, so let me go back. So I think that's a big deal. So carrybacks, that just explains what we just talked about.
Yeah, it just talks about, this is just kind of a visual to say cost segregation is kind of the foundation, but then once you add the bonus depreciation and the CARES Act on top of that, it really makes this stuff extremely powerful, especially like right now when people may not be getting the rental income they're used to, people are delinquent. All of a sudden you have an opportunity to generate some cash flow by going back and getting these refund checks.
I think that's really powerful.
Yeah.
That's awesome, Eric. So we just explained depreciation there, 39 for commercial and 27.5 for residential. For real property, personal property, engineer. So what is I've seen this term a lot. It didn't used to require that. What does that really mean, engineering-based study? We used to it's the same thing we used to do, isn't it? We just go break the segments down into, lights, carpet, fence, whatever it is, and then do it by.
Yeah, it does. The IRS does, though, require that somebody who's specialized can do it. So like your typical CPA, they don't have the construction knowledge to be able to go in and determine what type of piping is behind the walls or how much electricity is going to these different 5-year assets. So that's really the difference between an engineering-based study versus a CPA could just pull carpet out of an invoice or out of a group of invoices and say, okay, carpet's a 5-year asset. Yeah, that's great, but they're usually only going to segregate 10 to 12%. You really have to get in and kind of model these things, and it is done through an engineering-based study to get the full 30%.
No, that's good. That's just a term that's changed since, over the last, I don't know, however many years, 6, 7 years. And so I just wanted to be sure, because I know that after we did it, I wasn't interested in doing it anymore.
No. I don't blame you. It does require some special software and stuff like that. So
Yeah, it's just those time consuming, If I was
yeah,
a builder, but it's like, okay, no. And so title tax maximize personal property. Yep, I agree with that. Um, let's see, personal property tests removed. So that I
so these are just the
understand.
tests that determine what's personal property. Can you remove it without damaging the building? The main thing there is number 2, and that's the one that people often don't understand, and that's just basically saying your washer and dryer are a 5-year asset by nature, but so is the electricity and the plumbing for that washer and dryer. And so that's where you really have to have somebody who's got the construction knowledge to come in and determine the value of what's the conduit, what's the cost of the conduit going to the washer and dryer.
Got it.
So
And
it's
that's
not just the
actually
washer
fairly
and dryer.
significant.
It is, yeah. Our electricity allocation is usually the biggest portion that we find, especially on multifamily. You think about all the appliances, ceiling fans, all that stuff that goes into a multifamily unit, and then you times that by the number of units, all of a sudden you've got a huge amount of the electricity in that building was designed specifically for 5-year assets, which means that electricity is all 5-year components as well. So how do you put a value to that? And that's basically what we do in our studies.
No, I think that's awesome. So number 3, we're talking about relationships to the asset and the nature of the business. What does that really mean if we're not talking, commercial, industrial? We're talking, is there an application for that in residential?
Not so much, no. That's mainly for commercial. Like, for example, I always use the example, HVAC is not a 5-year asset, but if you have HVAC to keep a room of servers cool, then all of a sudden it becomes a 5-year asset. So no, really in a residential or multifamily, there's not a real application there.
Okay, all right, that sounds good. Then this just basically is talk about a lot of the different things that we can do. So I'm familiar with those. And then, the thing I like about you guys, so I've sent quite a few people to you. Justin Pouchard said he did like 10 or 12 properties with you.
Yeah.
That was good. Is I don't have to worry about it anymore.
Right.
Like what years, what's 5, what's 7, what's 15. I think I love it. And you guys, I'm assuming you put everything in a nice little packet and then just take it to our CPA and roll with it, right?
Exactly. Yeah, that's probably one of our big differentiators is that our reports are written for CPAs. So we provide them an actual new depreciation schedule that they just upload into their software and it's done.
Got it.
They go through it, 60 pages, but they go to the last page. They know what they're looking for. They look for our new depreciation schedule. They input that their software and they run with it. So
I think that's
I've
cool.
seen some of these reports that are hundreds of pages and you can't find any of the numbers you're looking for. They're there, but you guys got to dig through it and find them. So we try to tailor to the CPA.
I think that makes sense to me. I actually moved a property. I'm probably going to move another one in the last 6 months. I might have you guys go back and do one of both those. I should. I just, I get so overwhelmed with everything so residential assisted living home. So, and it just has to be over a tax year. So typically, you can do it in as little as 13 months, right? Or 12 and a half months.
In as little as 2 months if you buy it in December and sell in January, as long as it's over a tax year, especially with the bonus depreciation. So if you buy in December of 19, you take all your depreciation in 19, and then you sell in January of 20, then you have to calculate your recapture in 20, but you get to reduce that and pay it at a lower rate. So it really just has to be over a taxable year.
So you can do it over a taxable year. So I think so basically any time in the previous year to the current year.
Correct. Yep.
So, okay, that's good. The items classified, current claim portions. That's good. Dumpsters, outdoor landing. Yeah, self-explanatory. So, all right. So without cost sake, so 2019 be 21,000.
Yeah, so that's basically your straight line. You take the 1.2 million, divide it by 27 and a half, and you're going to get about $43,000 of write-off every year for the next 27 and a half years.
Sure. The 65 is what it looks like with segregation.
Yep.
So
this example you'll see is not with the bonus because your 5-year stuff, that $216,000 worth of 5-year assets, you're taking that over 5 years. In a bonus situation, you would be able to take the 216, the 12, and the 96,000 there across the bottom for your 5, 7, and 15 year.
Okay.
That 216, 12, and 96, you would be able to write that all off in the first year. In this example here, we're showing it without the bonus. So we kind of say, okay, here's cost segregation. Here's, you still get a nice 21,000 versus 65,000. So you still get an extra 43,000 even if you don't have bonus.
Sure.
But then we jump into some examples next where we say, okay, now that we've got the Tax Cuts and Jobs Act, now you're eligible for this bonus. here's how even more powerful it is.
Okay, so yeah, so basically, if you jump this forward, it looks like it'd be like a $49,000 benefit, actual benefit in pocket to somebody on a transaction like this.
Yeah.
Okay, so okay, that makes sense there.
Yeah, that just summarizes those bottom numbers there.
Okay, all right, and catch-up benefits.
This slide, just a lot of investors don't realize they think, well, I bought my property in 14, am I still eligible to do this? And so we just talked about, yeah, you're eligible, even though you've taken your straight line depreciation for the last 5 years, we'll do the study and take anything you missed and catch it up to the current year.
Okay.
And that's what that Form 3115. And so this is an example of that. Same property, but instead of buying it now, you bought it in 14. So all those things in the red circle there, you get to take all that depreciation and drop it in the current year.
Got it. So you can take the 203, and that's what the 203
The 203 in this example, yeah. So that's, especially for your single family investors, sometimes those are the most powerful studies, is when they've owned them for 3 or 4 years, and all of a sudden they take 3 or 4 years worth of extra depreciation in 1 year and drop it on their current tax return.
Yeah. No, I think that sounds awesome. So let's see, 1 year savings.
So this just summarizes those results, but basically that top line there, you had $196,000 of extra depreciation over those 5 years that you now get to take in the current year.
Okay.
So,
which makes,
and you don't have to amend, which is
yeah,
great.
Yeah, that's powerful, and you don't have to amend for that because you can take it in the current year. So I think that's good.
Yep.
So we did acquisition study current year.
This is just another study on a little smaller property, but you can see the point of this slide is just to say it even works on residential rentals. You're still getting almost a $20,000 tax savings on a $285,000 rental that you've owned since 14.
Yeah, no, I think that's hugely powerful. What's the 754 step up?
So that's usually on a like an estate where somebody has passed away. So if you own properties and I'm your son and you pass away and you hand me your properties over in your estate, everything gets stepped up to the current market value.
Okay.
So even though you fully depreciated your properties, if they're now worth $1 million, I get to then start depreciating them at $1 million over the next 27 and a half years.
Again, okay. And I've got, so, all right, am I going to pay it all back? Yeah, so this is an area that I have. So obviously it's the time value of money. We get the money now to use it. I like that. Deduction at a higher income rate, hopefully, and then reduce or eliminate recapture on personal property. So one thing I'm curious, so we've got the 25% recapture tax. If we're using chattel, depreciation for the 5, the 7 year, the 1 year, all those kind of things, does that expense out? So does that affect us? Because obviously those are being used up in their normal life. Do we still have to pay a 25% recapture on those or not?
So your 5 and 7 year stuff, you actually pay your recapture tax at your ordinary income rate. Okay. So depending on what your income rate is the year you sell, it could be anywhere from 0 to 37%.
Okay.
Your 15 and 27 year property is always recaptured at 25% at a maximum, or lower, depending. Like if you're in a 14% tax bracket, it'll be recaptured at 14%, but it caps out at 25. So even if you're in a 37% tax bracket, the highest you'll ever pay on that is 25.
Okay.
So the idea on that part is you take your deduction today, your ordinary income rate. So I'm in a 37% tax bracket, so I take my deduction against 37% taxes.
Okay.
When I pay it back in 5 years, when I sell my property, my 5 and 7 year stuff, I'm going to pay it back. Even if I paid it the full amount back at 39%, it's basically an interest-free loan from the government. So I had the money today, I paid it all back 5 years. It's a wash. But the idea is you're not going to pay it all back because your 5 year assets are now worth 0 because I've owned them for 5 years. And so it allows you, when you sell this property, it allows you to allocate the sales price to the right buckets. So what happens when you don't do cost seg is you buy a property for $1 million, you sell it for $2 million. You're saying that everything, the land, the walls, the carpet, the countertops, you're saying everything went up in value by $1 million. Okay. And you pay tax on that, which is not the case. Your land and your walls went up, but your carpet, your countertops, your cabinets, those all went down in value. Those are all personal property. They get old and they retire after 5 years.
Sure.
So when you do cost seg, if you own your property for 5 years, you're paying 39% tax on $0 because your property's got a book value of 0 after 5 years. Your 5 year property does.
Got it.
Your 7-year property has 2/5 value, or I'm sorry, 2/7 left after 5 years. So you're going to pay 39% on 2/7 of that. And so you're reducing your recapture by allocating the sales price to the right bucket. So hopefully that's kind of getting into the weeds, but the idea is take your deduction at a high rate and pick it back up on a portion of it at a lower rate on a future date.
Now that makes sense to me. That makes a lot of sense. So let's go on here. So we've got 2.5 million. So basically we're looking at a different, same thing.
Yeah, this is just some numbers here. This is a typical real estate transaction. You buy it for 2.5, you sell it for 3.3, you've owned it for 5 years. If you don't do cost seg, you're going to get a tax bill of $285 after on that transaction. And that's just straight line depreciation. You're going to pay your capital gains tax of 20%. You're going to pay recapture tax of 25, and those add up to the $285 there. And that's your tax bill. You made $800,000 on the sell, but you got to pay back $285.
Got it. So, and then this is with cost segregation.
This is with cost seg.
Huge difference.
Yeah, it is. So now you're basically doing those same calculations, but you're doing it for a 5-year bucket, a 7-year bucket, a 15-year bucket, and a 27.5-year bucket. And because you've owned it for 5 years, you're reducing the tax. And in this example, same example, but by doing the cost seg, your tax bill now is only $203 versus $285. So you're saving around $81,000 by doing and you've had the money in your pocket for 5 years.
And able to use it. Yeah, no, absolutely.
Yeah, and able to use it.
Yeah, we get 12% on our money, so we'd like that.
Yeah, so if you can have that money for 5 years, making 12%, that's good.
Yeah, so let's see. Do you want to explain this a little bit?
Yeah, so partial asset disposition is basically, and this works well for multifamily or residential rentals who are, replacing carpet often or cabinets, countertops, etc. But the idea is now that you've got these items line itemed, let's just use the roof, for example. Now that I know what the value of my roof is, because I did a cost seg study, before I didn't know the value. I just knew that I paid $1 million for this building, and I don't know how much of that million is for my roof versus walls. But when I do a cost seg study, we line item the roof, the windows, etc. So when you replace the roof is a 15-year asset, but if you've only owned it for 10 years and you replace it, it still has a book value of whatever 1/3 is, basically, because it's a 15-year asset, you've owned it for 10 years. If you replace it after 10 years, you get to write off whatever the remaining book value is as an expense. And so it's called a partial asset disposition. Now, the idea is that you then put on a new roof and start depreciating that new roof over 15 years. If you don't have a cost seg study done and you replace the roof, now you're depreciating the old roof and the new roof simultaneously, and you're creating a higher recapture upon sale because you're taking more depreciation that you should have expensed. Yeah, so having this stuff line itemed, then you can write it off as you retire the equipment per se. So when you retire your carpet, you get to write off the remaining basis.
So with this Jobs Act, so we're looking here, and it looks like, so what does the child tax credit have to do with this?
So if you click one more time, so this is all stuff that was in the Tax Cuts and Jobs Act. And I always say, please don't ask me about child tax credits. Don't ask me about AMT changes, because all we focus on is the bonus depreciation. That's the big part that affects real estate investors.
Boy, and that's been kind of amazing how it's changed over the years, isn't it?
Yeah, it's all kind of relative to what's going on in the economy. If they want to stimulate growth, then they'll add a bunch of bonus depreciation and say, go out and build stuff, create jobs, spend money. If the economy's doing good, they might lower it. Depends on who's the president at the time. And it was kind of frustrating because they wouldn't tell you till the end of the year what the bonus depreciation was going to be, so you couldn't really plan for it. So, but these are the old laws. The main one is that top one where it says requirements. It had to be original use property. So this is where the idea behind bonus, I don't even think they were considering real estate. The idea was go out and buy a new backhoe. So that it had to have a recovery period of 20 years or less. And if you think about it, the recovery period on real estate is 27.5 and 39 years. That's the depreciation life. So I don't think they even had real estate in mind when they came out with this bonus. But all of a sudden, when you do a cost seg study, now you have all this 5-year property that is new. You just built a duplex and you bought a bunch of 5-year cabinets. You bought a bunch of 5-year countertops. So that was the idea. And that's how we utilized the bonus in the previous years was if you built a new building, we segregated out 5, 7, and 15-year stuff. Well, that 5, 7, and 15-year stuff all has a recovery period of less than 20 years. So all of a sudden it's eligible for that 50 or 40 or 30% bonus, which was great. The builders love that because they're building this stuff and we're taking bonus and writing it off. But with the new tax law, the two big things are, I think the next slide is, you click one more time, is the recovery period, the bonus depreciation is 100% now.
Wow.
versus 50. And it no longer has to be new property. It no longer has to be new construction. It only has to be new to you as the taxpayer. So if I buy a building that was built in 1980, it's considered new to me, and now I'm eligible for bonus depreciation. And so those are the two big changes in the tax law. And then here just talks about the 100% bonus goes through 2022, at which point it'll reduce by 20% every year until 2027 when it'll be zero.
So we want to take advantage of it sooner rather than later, it sounds like.
Yeah, and I doubt this law will be around until 2027. Depending on who gets elected in the next election, this could go away as soon as next year if the Democrats get in and say, listen, we need revenue. We can't be giving these tax write-offs to everybody. They might say, let's go down to 20% bonus. Who knows?
Yeah.
But currently, the tax law reads that's 100% bonus through 2022.
No, I think that's awesome. It's and then super. So the difference between bonus and super bonus. Do you want to just touch on that?
Yeah, and I always make a joke here because super bonus is a word that we just made up. They really don't Google it. There's no such thing as super bonus. But basically what it is it's this new tax law, which has put everything on steroids. So this example is that same $1.2 million residential assisted living facility.
Yeah.
But now you're getting a $319,000, $318,000 write-off, which equates to about $127,000 tax savings. So you'll see there that 5-year stuff, the 216. Remember in our first example, that 216 was spread out over 5 years. Now you get to take all that in year one. Same with your 7 and your 15-year stuff. Your 27-year stuff still gets spread out over 27 and a half years. But your 5, 7, and 15, you get to take all that depreciation in year one. Yeah, no, that's a big, and this is on a $500,000 residential fourplex.
So this is a one that I've been using, which is basically, buy it for $400,000 and write off like $130,000.
Right. Yeah, that's it. As long as you buy it after September 27th of 17, that's the cutoff date. Anything purchased after September 27th of 17 is eligible for the bonus. And so, yeah, your numbers are right there. It's a substantial.
That's huge. Yeah. I mean, it's like,
that's your down payment on your next property, basically.
Right. No, I think that's really, really, really cool. So tax extenders. So I'm not so familiar with the tax extenders bill.
Yeah. So, and we just talk about one aspect of that that's highly overlooked. It's a tax credit called the 45L, and it's any home that was built. Actually, it doesn't even have to be built. Any residential living place, whether it's a single-family rental home, multifamily, that has a higher efficiency, that's 50% more efficient than the buildings that they were producing in 2006. You get a $2,000 tax credit per door.
Oh, wow.
So let's say you have an 8-plex that was built last year. We come in and we do an energy study on it, and we determine that it's more efficient than a 2006 standards by 50%, which basically any new construction is going to qualify just because the insulation's better, higher efficiency on the windows, windows, appliances, that kind of stuff. But basically, it's a $2,000 tax credit per door. So if you have a 4-plex, all of a sudden you're going to get an $8,000 tax credit. That's available to you, and it's an actual tax credit. So it's not a deduction like depreciation. It's actually, if you've got a $10,000 tax bill, they're going to credit you $8,000 on that tax bill, and so now you only have to pay $2,000. So anybody who's building homes or who owns, multifamily, it could be substantial.
It's huge. So what is the modifications of limitations on charitable contributions? Since I have a charity.
So don't add, again, this is a slide to say, here's everything that was in the CARES Act.
Oh, okay.
If you click one more time, it'll tell you what we're going to talk about.
Okay. That sounds good. Because I was like, I was trying to decide if there was an application for the bonus depreciation.
There probably is, but you'll have to talk to your CPA about that, because I just focus on the two things in the CARES Act that really affected real well. There was 3. The 45L tax credit was part of the tax extenders. But the CARES Act, there was a mistake made in the original tax law back in 18. So there used to be something called qualified improvement property.
Yes.
Now, qualified improvement property only applies to non-residential property. So this wouldn't apply necessarily to your group if they're dealing in residential rentals. But let's say I own a strip mall and I bought it in 2017, and then I spent $100,000 in 18 to renovate one of the spaces for a new dentist that was coming in. That $100,000 of renovation, instead of depreciating that over 39 years, I was able to depreciate that over 15 years.
Got it.
And because it was a 15-year asset, all of a sudden it became eligible for bonus, which means I got to take, back in 17, I got to take 50% of that in the first year. When they came out with the new tax law, they wanted to continue to make it 15-year property, but they screwed up and they accidentally forgot to leave that or write that into the 2018 bill. So for the last, since 18 until now, everyone's been saying, you guys need to fix this, you need to fix this. Well, in the CARES Act, they finally fixed it. And so if you've improved any commercial properties, you now get 15-year asset, 100% bonus on it, versus the way it was written, you had to keep it as a 39-year asset and depreciate it over 39 years.
So we talk about commercial property. Obviously, rental property can fall into that one, or multifamily. What would it? I'm just wondering. So if, let's say you have a house and you're renting out the basement apartment, is there anything that's available there, or is that just too far of a stretch?
No, it's not. It's too far of a stretch. And even your multifamily, for depreciation purposes, is still considered residential. So it has to be a 39-year asset. So as long as anything where you've got somebody living there is considered residential for depreciation purposes, even if it's a 300-unit apartment building.
Okay.
Some people will refer to that as commercial, but in depreciation world, that's still considered residential, and the IRS requires you to depreciate over 27 and a half.
Right, but you can still do a cost seg study on a 100-unit apartment
Absolutely.
building. Yeah.
You just can't. Let's say you bought an apartment complex with 300 units in 17 for $1 million, and then in 18 you put 500,000 in to redo all the units.
Yeah.
It doesn't qualify for the qualified improvement property because it's not a 39-year asset.
Got it. Okay, but
So
you can take all the other
retail, office buildings, retail office, medical space, that type of stuff.
Sure, but you can take all the other benefits of the cost segregation and bonus and all that other stuff. Yeah,
Correct.
So that's awesome. So net operating loss carries back. So yeah, we talked about that a little bit, but that could be really powerful, like you said, where maybe you need some money now because your tenants aren't paying. I've had a couple that have been struggling, and we go in and do this study and then take it back and actually get some of the money we paid the government back this year by using this CARES Act 5-year carryback.
Exactly. Yep. And so I think the next slide is probably the most impactful, but I think there's an example, if I'm not mistaken, on the next slide. But basically, yeah. So here's you got a client who's got 100,000 of income in 2020. If they do a cost seg study on their portfolio of properties and it generates $525,000 worth of depreciation expense, you first wipe out that 100,000 of income for 2020, so they pay no taxes on that. But then the remaining 425 you get to carry back. And so this is an example here. If, let's say they had 75,000 of income in 2015, first you would knock out that. That's about a $16,000 refund check. Then you carry forward the remaining, knock out the 150 in 2016, and you're going to get a $35,000 check. And then you have 200,000 left over. That'll hit your 2017 tax return. In this example, they made 400,000 of income. So that $200,000 gets taken off of that. So basically you're going to get a refund for about $115,000. Whoops, there's a dot there. 115,000, which again, you may not even knew that was available. I mean, you only had 100,000 of income this year, but you got a bunch of properties you've never done cost seg on. All of a sudden you do cost seg, create that net operating loss, and could be an opportunity to get a big refund check.
That's huge. I think, I can see this one here. I've got a few properties we've acquired in the last 4 years that I'm thinking we need to to have you take a look at.
Yeah, especially for this one's important, and I always drive home, especially for real estate professionals, because they qualify for this net operating loss. So all your brokers, all your agents that own property, they already qualify as real estate professionals on their tax returns. So, if they're paying taxes or have paid taxes in the last 5 years, they may be able to recoup some of those taxes.
And I think that's truly awesome. So let's see.
And this just goes back, I kind of just tie it all together and say, it goes back to the pyramid here. But
so the foundation is cost segregation, then you add on the TCGA, which was the Trump bonus tax stuff, and then the CARES Act, and it's huge. I mean, that's and so I am probably least familiar with the 45L tax credit.
Yeah, and like I said, it's basically it's $2,000 per door for any property that's built that has a higher efficiency, that's 50% more efficient than the 2006 standards. And so it does require that you have a third party come in, and we do blower door tests, and we see what kind of insulation you have, what kind of heating and air you've got, and we plug all that information in, and it tells us if it's more efficient or not. And then we provide whomever a certificate saying, submit this certificate with your tax return and you get a $2,000 credit per door.
No, I think that's really just.
But the whole idea there is it was around up until 2017. With the Trump tax plan, they got rid of this credit, and they just recently reinstated it and retro dated it to 17. So anybody between 17 and now who's built new homes is eligible for that tax credit.
So if you had done a total remodel in the last 5 years and put so my house has the reflective foil and 35 inches insulation in the attic, and and we studded out furred out all the walls, and so now I've got insulation that's R21 all the way around the outside of the house. Can you still take that credit?
Yes. Well, no, for you, no, because the way you take the credit is you do have to amend your tax return, and you're out. If you did it 5 years ago, you're outside of your amendment window, your 3-year amendment window. So it would have had to be done back when you did it. They are letting you go back now because they had discontinued this in 17, but basically you have to amend 17, 18 to be able to take these. You have to take the credit in the year that you do the rehab or the construction.
Got it. So it makes sense.
Yeah.
It needs to be current and recent.
Yep. Or within the last 3 years, because you can still amend.
Okay.
So here's just some of the different things that would help you qualify. Like I said, we found that most new construction, we had one project where they had all this high efficiency stuff, but then they ran the ductwork through crawl space. You've got these great coolers and they create this nice cold air, but then they run it through a hot crawl space and it loses all of its coolness. And same thing in the winter time. You take hot air, but you run it through a cold crawl space. So in that instance, some of those houses didn't qualify, but for the majority, 80 to 90% of new construction, just because of the materials available today, will qualify for this credit.
Sure.
And this just goes through some common questions that we get. Can a remodeling project qualify?
We just talked about that. So
Yes. Can I apply for this for past properties I built? And we talk about how it has to go back 3 years.
Yeah. So that's so it's got it short. So it's $2,000 a door. If you've done it over the last 3 years, that could be powerful.
Yeah.
So let me ask you a question here. So I guess you couldn't do. I was trying to think on the properties I flipped over the last 3 years, but you wouldn't be able to go in and do a study on there because we've insulated lots of those, put new windows in, the doors, the whole 9 yards, the reflective, roofing. But it sounds like you need to be able to go in there and actually run a test on them.
Yeah, that is the challenging part. So we had a couple builders who had built, a couple hundred houses, and what they did is they sent an email to all the people who bought their homes and said, listen, we'll give you a $100 Amazon card if you let us come in and do an analysis for 20 minutes. And so they had a good response. There's some rules and stipulations where you don't have to see every property. So in your case, we would probably have to see every property, but a builder who builds the same home 200 times, we can do some modeling and say, yes, they use the same materials, these homes qualify. On you, where you're doing individual renovations, we probably would have to get into each of the homes to determine whether they qualify or not. So that is one of the challenging parts, because you do have to deal with tenants and trying to explain to them why you've got somebody in there crawling up in their attic.
Yeah, no, but you're saying it only takes like 20 minutes?
Yeah, it's not, well, depends on if you've had a blower test door, or a blower door test done. That's the one that takes a little bit longer. So some new construction will already have that done as part. Some counties actually require it. If the county doesn't require it, then we have to bring in the equipment to do it, and it might take a little longer. But it's not more than an hour per home, even if we have to do the blower door test. It's
okay. So that would just basically just test the. So that might be worth doing. I mean, if I was to reach out to the people that bought homes from us and say, we'll give you a $100 gift certificate to, a nice restaurant or
right,
something like that, then. Because I've got 15 flips going right now.
And so when you flip, do you typically take it down to the studs, or does it depend? I guess probably depends on the property.
It depends on the property, but I've got one right now that we did. And
so those are the ones that are most likely to qualify. Like if you go in and you maybe put in some new high efficiency appliances and new carpeting, it's probably not. The things that are really important are windows, insulation, and heating and air. So if you replace those three, then there's a good chance it qualifies. If you haven't replaced those three, then it probably won't qualify.
Yeah, so I've got one like that where we've done that. That is, it just went under contract the other day. We'll close it in 3 weeks, but it sounds like it might be worth having you guys come do a quick one on that one.
Yeah.
So yeah, that's just that's yeah, it's amazing. I love it. It's and there's no maximum on the.
Nope. If you built 500 units, you could claim $1 million. There's no max on that. So
that's awesome.
Yeah, and this is just kind of a summary slide, what it means to you as an investor or someone in that industry. So it just talks about kind of summarizes it for us, and then it's got our contact information.
Okay, so I think that's